Single best chart with a qualified David Bailin of Citi Private Bank. It's the yield curve in Germany. That's where the disinflation is. That's a slowdown. Here's the yield curve right now. Here's where it was in October. And all you got to know, negative yields here. Negative yield has shifted out, David, from a 5-year duration to a 9-year. Robin Wigglesworth in the FT showing the Deutsche Bank chart of increase negative yielding debt. Are we going back to 2016 with this chronic negative yield environment?
That's, we did a comparison of 16 to 18, and that's exactly the conclusion that we drew, is that you're sort of looking at this market and asking yourself whether we were back in 16. And certainly starting on January 1st, the answer was yes. There's a lot of fear in the marketplace, a lot of it, in respect to the idea that we're in a very, very low growth or negative growth.
So is it like 2016?
Yes, and exactly. And that's why we're telling, clients now, Tom, that we want them to actually, put money back into the markets in equities, because this turned out to be sort of a head fake in 2016. And in many ways, the bond market, which I tend is smart, but that's, go ahead.
The mathematics on this is incredibly important. Marvin Goodfriend wrote that paper at Jackson Hole. He wants much larger negative rates under emergency. But are we under emergency now?
We're not under an emergency now, Tom. And when you say wants those rates, what he's talking about is the idea that you can fund basically an infinite amount of debt if you're not paying anything for it. But in terms of its ability to support the economy, it's basically used all of its juice at this point. It is not, stimulating more growth in Europe. We saw the decline, the projection decline in European growth. So, our view is that this is indicative, I think, of a fear factor right now, but not one that's particularly beneficial in the long run for Europe or for the global economy.
All right, David, let me ask you this question. We've been trying to figure out, when will the 10-year bond yield trade below Japan's 10-year yield? I mean, this has huge implications, right, for basically what you think of Europe, and also the resurgence of negative yields in Japan, and the fact that now they could look attractive.
On a relative basis, I think you're right. I mean, that is something that, you're close enough to actually be able to anticipate. So it's a good question. And I think psychologically it'll have a significant importance. One of the things we're doing now, though, is really steering clients to look at where there are high yields available in the market to build into their portfolio. And really what we're also interested in is the yield differential. And that is actually expanded between emerging markets, the U.S. market, which has got unusually high yields relative to developed markets, and to your point, to Europe and Germany and Japan. Clients are getting this opportunity right now to put money to work in these high yield markets. And that is something that we're seeing happen with a great deal of frequency. And we think it's a real opportunity for them relative to equities.